Hey everyone, welcome back to We Are Cosmic, the channel where we dive deep into cryptocurrency, finance, and the moves of smart money. If you're serious about understanding how the biggest banks and institutional investors are quietly shaping the market while retail traders chase charts, you're in the right place. Today we're going to break down exactly what's happening with XRP and why the numbers you see on the surface don't tell the full story. Let's start with the big picture. Many people holding XRP are frustrated with the stagnant price around 140. You might be thinking, why isn't it moving? The charts are flat. But here's the thing. This stagnation is actually a signal. It shows the exact moment when institutions see an opportunity. While retail investors panic or get bored, the world's largest banks and hedge funds are quietly taking control. We are currently witnessing one of the biggest wealth transfers in cryptocurrency history. On one side, retail investors are selling their tokens out of frustration or impatience. On the other side, institutional buyers are scooping up every available XRP at these levels. This isn't just a market fluctuation. It's a deliberate accumulation by smart money, preparing for the next structural move. Here's what the data tells us. Wallets holding less than 1,000 XRP are disappearing from the network at record speed. These small holders are being replaced by institutional-sized positions, wallets controlled by banks, hedge funds, or ETFs. These investors don't care about short-term price swings. Their goal is to secure supply without causing a spike that would scare off retail sellers. This is why the price appears flat while billions of dollars in demand quietly flows into the market. In fact, cumulative ETF inflows into XRP have already reached over $1.2 billion. These inflows bypass exchanges entirely, meaning the normal price discovery on platforms like Binance or Coinbase doesn't reflect the real buying pressure. Institutional buyers are working behind the scenes, absorbing liquidity, and effectively setting the stage for a supply squeeze. So, what does this mean for regular holders? If you're sitting on a few thousand XRP, you're already in a stronger position than most of the retail market. For context, holding around 2,500 XRP places you in the top 10% of holders, and 50,000 XRP puts you in the top 1% worldwide. This is a massive shift. Ownership isn't just about speculative trading anymore. It's becoming a form of financial exclusivity. One of the most important concepts to understand here is that XRP is moving from a speculative token to a core financial asset. Institutional investors aren't guessing, they're positioning themselves strategically. They know that once supply is locked into cold storage or ETFs, the market will have a terminal floor. This means that the open market supply will be limited and future demand will push prices higher. Even during recent dips to 120, we saw an interesting pattern. Retail holders were leaving, but new accumulation wallets surged by over 50%. This means that for every small investor selling, a larger whale was stepping in to buy at a discount. This coordinated shakeout is happening right now, and if you wait for the price to jump before buying, you may already be too late to join the most advantageous positions. Finally, it's critical to understand that XRP's scarcity isn't just hype. While billions of tokens exist, the free-floating supply, the coins actually available on exchanges, is shrinking. The numbers show that XRP is rarer per capita than almost any other top-tier crypto asset. That's why today, even holding a medium-sized position gives you more influence than you might think. First, let's talk about over-the-counter, OTC buying. Unlike regular trading on Binance or Coinbase, OTC desks allow institutions like Bitwise, Franklin Templeton, and others to purchase hundreds of millions of dollars worth of XRP without triggering panic or a price spike. This is crucial because if they tried buying the same amount on open exchanges, the price would shoot up instantly, attracting retail attention and potentially scaring off other buyers. OTC is like a private shopping cart for whales, letting them quietly accumulate supply. Next, consider ETF inflows. XRP ETFs have been steadily absorbing liquidity. Billions of dollars moving into these funds bypass exchanges entirely. This is why you might see the price stuck in the 130, 140 range, while billions are still flowing in. These ETFs are essentially locking up XRP in institutional custody. Once these coins are in vaults, they're no longer available for trading, which slowly tightens supply on the open market. The more supply is locked, the stronger the floor for future prices becomes. Another key point is the behavior of small versus large holders. Wallets under 1,000 XRP are rapidly disappearing. Many small holders are selling in fear or boredom, while whales and institutions take advantage of these panic sales. The result is a shift in ownership. The market is moving from being dominated by retail wallets to being concentrated in fewer, larger hands. This is important because as liquidity concentrates, the market reacts less to short-term volatility and more to structural supply changes. We also see a strategic patience pattern. Large institutions are not looking for quick profits. They're accumulating over long periods, weeks and months, patiently building positions without letting retail traders know. For example, ETF inflows show a 55-day consecutive net inflow streak, meaning institutions are consistently buying day after day. While retail traders panic during sideways price action, these investors continue to absorb liquidity quietly. Now let's consider the supply shock effect. As more XRP moves into cold storage and institutional vaults, the free-floating supply shrinks. Even small upticks in demand can now have outsized effects on price. Think of it as a river drying up. A little extra water from new buyers can create a big surge downstream. This is exactly why understanding supply distribution is more important than obsessing over daily candle patterns. An important statistic, the total sellable XRP on exchanges has dropped to around 1.7 billion tokens, the lowest since 2019. This creates a situation where even modest institutional buy orders act like a vacuum, pulling up prices because there simply aren't enough coins left for sale at current levels. This is the foundation of a future institution-driven breakout. Finally, let's look at retail psychology versus institutional strategy. Retail investors often panic sell at small dips, creating opportunities for larger players to step in at a discount. Social media hype and food amplify this behavior, but institutions are playing a completely different game. They're focused on distribution and scarcity, not charts or trends. Understanding this is the key to staying ahead in 2026's XRP market. First, imagine the XRP ecosystem as a pyramid. At the bottom, you have small retail holders, people with fewer than 500 XRP. These wallets are extremely common and are often left on exchanges, making them vulnerable to shakeouts during market dips. In fact, most of the retail market sits here, barely influencing the overall supply. Next, the accumulation class. These are holders with around 500 to 2,500 XRP. By comparison, holding this amount already puts you in the top 10% of all XRP holders worldwide. You might think that's a small number, but considering the global population and distribution of crypto wealth, it's actually quite significant. These holders aren't whales yet, but they are now structurally important. When institutions accumulate, they consider this layer part of the stable base of the market. Above them, we have the elite 5% holders. To reach this tier, you need roughly 8,500 XRP. Now you're entering the level where your position can directly influence liquidity. You're not just a spectator anymore, you're part of the structural supply that the market relies on. If this tier starts selling during a shakeout, it can trigger major price moves, which is why institutional players watch these wallets closely. At the very top is the legendary 1%, holders with 50,000 XRP or more. Only a tiny fraction of people worldwide achieve this level. These are the whales that institutions compete with when accumulating large positions. They effectively control a significant portion of liquid supply, and their actions determine the market floor. If you're in this tier, you are effectively part of the institutional level infrastructure that enables XRP to function as a global settlement tool. Now, why do these tiers matter in 2026? The answer lies in the concept of the terminal floor. Institutional investors know that once the small and medium retail supply is absorbed into vaults and ETFs, the available XRP on exchanges will hit a critical floor. At that point, even modest buying pressure from institutions or retail buyers can trigger large upward moves, simply because the remaining coins are scarce. This is different from a typical speculative rally. It's a structural shift. Let's visualize it. During the recent dip to $1.20, retail wallets sold in panic, but accumulation wallets surged 51.5%. For every retail investor exiting, a whale or institutional buyer entered. This demonstrates the real power dynamics. While the price appears stagnant, the distribution is shifting heavily toward larger holders. The market is quietly being reorganized from the bottom up. Another key takeaway is supply scarcity. Despite billions of XRP in existence, the actual circulating supply on exchanges is very limited. With only about 5.1 million active wallets globally, XRP is rarer per person than almost any other top-tier asset. Institutions know this and are acting strategically. By locking supply and custody in ETFs, they create a situation where the market must respond structurally, not emotionally. So what does this mean for you as a retail investor? If you hold 5,000 XRP, you are already outperforming 90% of participants. You are no longer just watching charts, you are structurally positioned for the next major move. But if you are holding fewer than 500 XRP on an exchange, you are highly vulnerable to shakeouts and liquidity traps. Finally, understanding your position in the global XRP hierarchy is critical. This is the real measure of influence and potential upside. Price alone doesn't matter as much as supply control. Institutions have already chosen their side, and they're setting up a future where only the well-positioned holders, medium to elite tiers, benefit from the coming liquidity squeeze. So, what is a supply shock? Simply put, it happens when the number of coins available to buy on exchanges, the free-floating supply, drops sharply. In XRP's case, millions of tokens are leaving hot wallets and exchanges, moving into cold storage, ETF custody, or institutional vaults. This reduces the number of coins that retail traders or new buyers can access. When demand remains steady or increases even slightly, the limited supply forces prices to rise sharply. Let's look at some numbers. Total sellable XRP on exchanges has fallen to around 1.7 billion tokens, a historic low not seen since 2019. At the same time, institutional inflows continue relentlessly. ETFs and OTC purchases are quietly absorbing liquidity, and the result is that the market is reaching a terminal floor, a level where almost all remaining tokens on exchanges are controlled by larger holders. Why does this matter for retail investors? Imagine trying to buy XRP once most cheap coins are already locked away. Any new buying pressure will have to target the limited supply left at higher price points. This is the moment when a supply-driven rally can occur. The price doesn't move because of hype or speculation. It moves because there aren't enough coins to meet demand. Another key factor is the behavior of OTC and institutional buyers. They are not trying to trigger a quick pump. Instead, they are accumulating strategically, often for months. OTC desks allow them to purchase hundreds of millions of XRP without causing spikes on public exchanges. This keeps retail traders in the dark, thinking the market is flat while the real supply dynamics are quietly shifting. Even short periods of zero flow on ETFs are often psychological traps. Retail investors see stagnant prices and assume institutions aren't buying. But in reality, these pauses are tactical. They encourage small investors to sell, providing the liquidity needed for the next big institutional buy. This is why understanding supply distribution is far more important than watching daily candle charts. We also need to talk about the impact of escrows. Ripple still controls nearly 39 billion XRP locked in escrow. If regulatory delays slow down institutional adoption, some of this supply could hit the market. But smart money is positioning now to absorb as much as possible before any release. Once the market's free float reaches the terminal floor, even minor upticks in buying demand can push prices dramatically higher. To put it simply, XRP is becoming illiquid on a structural level. The market is shifting from a state where anyone can sell at any time to one where supply is concentrated in fewer, stronger hands. This is why holding the right amount today, not just chasing price spikes, is critical for future gains. Medium and elite holders stand to benefit the most, while small holders on exchanges risk being squeezed out. Finally, this is not random or speculative. We've seen historical parallels with Bitcoin ETFs. First, coins leave exchanges, then the price reacts. The current XRP setup mirrors that pattern. Supply dries up first, then a structural move upward follows. Understanding this sequence is key if you want to think like an institutional investor rather than a retail trader. First, let's address risk management. One of the biggest mistakes retail investors make is keeping all their XRP on a single exchange. Exchanges can fail, go offline, or suffer technical issues during high volatility. If your coins are trapped during a sudden price surge or crash, you could lose your opportunity to buy, sell, or even protect your position. The solution is redundancy. Spread your holdings across multiple Tier 1 exchanges and consider using hardware wallets for long-term security. Next is position sizing. Knowing where you sit in the XRP wealth tiers matters more than chasing hype. If you hold around 5,000 XRP, you're already outperforming 90% of the network. This gives you a structural advantage in the supply-constrained environment we discussed in Part 4. But if you hold less than 500 XRP, your influence is minimal, and you risk being the exit liquidity for larger players during a shakeout. Understanding your tier helps you decide whether to accumulate more, hold steady, or diversify. Another important tactic is timing your moves. While retail traders obsess over 140 price resistance or minor dips, the elite are focused on distribution cycles and supply shifts. They understand that when institutional wallets dominate and exchange liquidity hits a terminal floor, even small buying pressure can trigger outsized moves. The lesson here: don't react to daily volatility. Anticipate structural changes instead. Cashback and staking strategies are also worth noting. Some exchanges, like Kraken, offer immediate benefits such as a 3% cashback on deposits, effectively giving you more XRP just for moving coins into secure positions. Over time, these structural advantages compound, separating retail investors from the more strategic holders. Small optimizations in storage, staking, and transaction timing can significantly enhance returns, especially during periods of high scarcity. Let's also consider psychology and patience. The 1% aren't necessarily smarter, they simply have a blueprint and the patience to execute it. They are not trading based on fear or hype. They are tracking supply flows, accumulation patterns, and the timing of institutional moves. Retail traders often panic at zero flow days, but these can be tactical pauses by smart money designed to bait sellers. The key takeaway: don't get emotionally trapped in the market. Your strategy must align with structural dynamics, not headlines. Finally, let's talk about structural positioning for the future. XRP is moving from speculation to becoming a core financial rail. With RLUSD stablecoin adoption and institutional banking integrations, demand is increasingly structural. The supply shock, ETF accumulation, and scarcity in exchange liquidity create a scenario where medium and elite holders stand to benefit the most. If you're strategically positioned, you're not just waiting for the price to rise, you're part of the foundation that makes the system function. In summary, spread your holdings across multiple exchanges and wallets, understand your tier, small, medium, or elite, and position accordingly. Focus on supply dynamics, not short-term price movements. Take advantage of strategic bonuses like cashback or staking. Be patient and think like institutions, not retail traders. The most important thing to grasp is that XRP is no longer just a crypto token. It's evolving into a core financial rail for global banking. Institutions are building infrastructure to use XRP for cross-border payments, liquidity settlement, and as a bridge asset via the RLUSD stablecoin. This means that demand is increasingly structural, not speculative. Price action may seem stagnant at times, but behind the scenes, supply and liquidity are being re-engineered by smart money. Think of it this way: retail traders are like spectators watching a soccer game from the stands, while institutions are the coaches and players controlling the field. They know how much supply is available, where coins are moving, and when liquidity will tighten. By 2026, these institutions will control the majority of sellable XRP through ETFs, custodial wallets, and cold storage. Once the terminal floor is reached, the market will no longer behave like a typical speculative asset. Every new buy order will have a bigger impact because there are fewer tokens left to trade. We also need to consider the scarcity dynamic. Despite billions of XRP existing in total, only a fraction is actively tradable. With roughly 5.1 million active wallets globally and exchange reserves at historic lows, XRP is becoming rarer per capita than almost any other Tier 1 crypto asset. Institutional accumulation combined with supply-leaving exchanges creates a scarcity-driven framework that could power significant price moves when demand rises. Another factor is the shift from pilot projects to production-level adoption. By mid to late 2026, roughly 50% of Fortune 500 companies are expected to hold crypto assets, integrate stablecoins, or engage with tokenized settlement systems. This means that XRP is moving from the fringes of finance into the core operational layer of global payments. It's no longer about speculation, it's about execution, reliability, and liquidity. For retail holders, this has huge implications. If you're strategically positioned in the right tier, say 5,000 XRP or more, you're part of the structural supply institutions rely on. You're not just waiting for price to move. Your coins are part of the global system that enables XRP to function as a bridge currency. Conversely, small holders under 500 XRP who leave coins on exchanges risk being left out of this structural growth or worse, providing liquidity to institutions selling strategically. The final piece to understand is timing and execution. Institutions aren't chasing short-term gains. They are patient, methodical, and data-driven. Every ETF inflow, every OTC purchase, and every vault deposit is part of a coordinated accumulation strategy. Retail sentiment, social media FUD, or small chart movements don't influence them. They're watching the distribution of supply and positioning themselves for structural gains, not temporary spikes. So, what's the takeaway? XRP in 2026 is entering a phase of institution-driven scarcity and structural adoption. The volatility you see today is mostly noise. The real game is being played behind the scenes in vaults, ETFs, and OTC desks. Understanding supply tiers, terminal floors, and institutional accumulation is far more important than chasing short-term price action. To conclude, the XRP market is no longer a playground for speculative retail traders. It's becoming a professional, infrastructure-driven ecosystem. Medium and elite holders stand to benefit the most, while smaller holders need to be strategic, diversified, and patient. If you can think like an institution, manage risk, and understand the supply dynamics, you can position yourself to survive and even thrive as XRP transitions into a core global financial asset. Thank you for following this We Are Cosmic breakdown. Remember, the difference between retail exit and ledger level success is information speed, strategic positioning, and patience. If you want to stay ahead of whale moves and institutional accumulation, check out our Discord link in the description for real-time tracking and professional insights. Stay informed, stay strategic, and keep watching the ledger. The future of XRP is unfolding right before our eyes.